Startup exit strategy. The success of a startup goes beyond merely creating innovative products or services and growing. Ultimately, it is crucial to establish an exit strategy, which is the stage where founders and investors receive compensation for their efforts and investments, realizing returns. This is also an essential element in creating a virtuous cycle within the startup ecosystem. What is an exit strategy? An exit strategy refers to a plan for startup founders and early investors to ultimately recoup their investment in the company and realize investment returns. Startups raise capital and expand their business while remaining privately held. Investors, in turn, provide funding with the expectation that the company will successfully grow, allowing them to cash out their shares or sell them at a high valuation later. Therefore, an exit strategy is critically important not only for founders, but also for the investors who supported the startup's growth. Types of major exit strategies. The primary exit strategies for startups can be largely divided into two categories: initial public offering (IPO) and mergers and acquisitions (M&A). Initial public offering (IPO), meaning an IPO means listing privately held shares on a stock exchange to sell them publicly to general investors. Through this, a company can raise substantial capital, and founders and early investors can recover their investments by selling their shares on the market. Pros: large-scale capital raising listing allows for raising massive capital, providing a foundation for business expansion and further growth. Increased corporate value and recognition. The status of a publicly listed company enhances external credibility and significantly boosts brand recognition. Asset liquidation for early investors and employees. Founders, investors, and employees who received stock options can liquidate their shares to realize profits. Cons: complex and lengthy process. Preparing for an IPO is very complex, time-consuming, and requires passing strict review criteria. High costs. Significant fees, legal costs, consulting fees, etc., are incurred during the listing process. Increased management transparency and regulation. After listing, companies face intensified management transparency requirements and regulations, including external audits and various disclosure obligations. Failure rate. Statistically, very few startups succeed in reaching a successful IPO. Mergers and acquisitions (M&A), meaning M&A is the method of selling the company to another entity. Large corporations or other mid-sized companies acquire a startup's technology, talent, market share, or business model to strengthen their competitiveness or expand into new businesses. Pros: faster capital recovery. Investment can be recouped in a relatively shorter period compared to an IPO. Lower initial costs and complexity. Unlike IPOs, M&As do not incur complex procedures or high costs associated with listing preparations. Strategic synergy. Business can be expanded on a larger scale by leveraging the acquiring company's resources and network. Reduced burden on founding team. The founding team can reduce management burden and explore opportunities for new ventures. Cons: valuation issues. There is a risk that the company may be sold at a valuation lower than its actual worth. Loss of management control and independence after acquisition. The founding team or existing management may lose control or find it difficult to maintain independence. Cultural clashes. Difficulties or internal conflicts may arise during the process of integrating into the acquiring company's culture. Low success rate. Even in Silicon Valley, the success rate for IPOs and M&As is not high. Specifically, it's noted that the successful exit rate is statistically within 3%. Considerations when choosing an exit strategy. When a startup chooses an exit strategy, various factors must be considered comprehensively. Growth stage and company goals. It is important to clearly define the current growth stage of the company and its long-term goals. The strategy will differ depending on whether the aim is to quickly establish a market presence or to grow into a massive unicorn company. Founder and investor intentions. Alignment is needed on the founding team's vision, investors' expected returns, and the timing of capital recovery. Market conditions and competitive environment. The market environment must be analyzed, considering whether current IPO market conditions are favorable or if there are strategic acquirers interested in M&A. Financial health. Consideration must be given to whether the company has sufficient financial stability to prepare for an IPO, or whether its business model can be valued adequately through M&A. Conclusion: an exit strategy is a crucial step for a startup's successful conclusion, completing the virtuous cycle of founding, investing, and growing. It is a wise approach not just as a final goal, but to build and develop the business with a potential exit strategy in mind from the initial planning stages. This guides the company's direction, positively influences investment attraction, and ultimately leads to greater success.